And yeah, okay, we are live. So welcome everyone. This is the September community meetup of 2020. We have been doing this for I think 6 months now, online via Zoom. And so appreciate you guys keep joining us even while it's not a normal meetup where we can see each other. Today we have a special guest from Taiwan, Tempo, who's running Perpetual Protocol. Will be giving us a talk on automated market makers and virtual automated market makers shortly. And after that, we'll have a discussion on liquidity mining and yield farming. But before all that, let me just do our normal monthly roundup. So for this month, some announcements. There is a Crypto Malaysia meetup tomorrow at 5:30 p.m. At Asia Blockchain Center. I believe this is in PJ. So if people are interested, I'll be sharing the link later. And you can join. Separately, there's a, in Etherscan's monthly newsletter, there's a win $10 in ETH prize for answering a quiz on yield farming. So if you want to just make sure you've reviewed your, you know what yield farming is about, you can take that quiz and you stand a chance to win $10. Let me see, I have some comments here quickly. So YZ Money asked about wanting to know about liquidity mining on a perpetual contract. That's a good question. We will, you can ask Tempo that question afterwards during his Q&A session. Johnson's asking if we're live on YouTube. No, it's on Zoom only right now and I'm recording it. I will be uploading the recording on YouTube afterwards. Cool. So it's just some stuff that's happened last month on Ethereum. I didn't catch anything happening in the local news, so I have no local news to share. But as always, there's a lot of things going on globally. And first, I don't really have to say this. I think everybody already knows. But we've seen a lot of yield farming things happen in August. That's basically a lot of memes. Some projects literally only have memes and a copied smart contract code base. Some of you already know my opinions on YAMM itself and rebasement, but you know that's for another discussion. But it has shown like a powerful thing where a project that doesn't have a real company that has only smart contracts can raise. I think at one point they had like more than $600 million in their locked in their contracts. So that's a very powerful, powerful thing that Ethereum has enabled. Then there was the sort of Medaja testnet incident, or more like Medaja testnet crash. So for those of you who run validators, you've seen that ISM had this problem, and then because 65% of nodes were on them, the whole system crashed. So that's, you can see it as both a good and a bad. It's bad because the system went down, but it's good because that's the whole point of doing testnet. And yeah, if you don't already have a ETH2 validator, please feel free to run it. I've had some requests by people to run a ETH2 validator how-to meetup, and yes, if you're interested, let me know in the chat. And we can arrange one with everybody. Christian's adding here vampire mining, which I believe is related to SushiSwap as one example, kind of like relying on someone else's liquidity, but maybe you can add a link in the chat later. And Johnson saying 1.4 billion, yeah, that's already broken past YAMM's record. Let's hope they don't have a, I think people have checked it out, but let's hope there's no bug that locks people's people's stake inside that contract. A third news item is SAP, one of the largest essentially enterprise software houses in the world, wrote a very good sort of introduction to Ethereum for enterprises, and including a live demo, and it's on Ethereum mainnet, which a lot of people previously have only been using Ethereum on sort of Quorum or other permission versions. We also have MetaMask announcing that they're changing their license. So for most people like you and I, you probably don't have to worry about this. But if you're running a project that's using MetaMask's code base and you have more than 50,000 users and you're commercial, you would at that point have to enter into sort of financial discussions with MetaMask. For those of you who haven't been spending all your time on yield farming, there was actually a cool game using zero knowledge proofs on the Robston testnet. I think they had 140,000 transactions, which would have completely broken mainnet if it was done there, but it wasn't, and it was pretty cool in a kind of 90s type of, if your expectations is that of a 90s kind of game. Yeah, so I don't know if anyone else played. I played, and I think Caleb did. Yeah, if you did play, let me know what was your score. I think I was 127. So yeah, not one of the most impressive ones. And I think the last news article I have is there's a supply gate. Some Bitcoiners were talking about how Ethereum supply can't be audited. And I mean, you can look through the thread, and I'm sure a lot of you have also read through the various Twitter threads around this, but I just thought to bring it up because it's cool to note that essentially it's a different culture between Bitcoin and Ethereum, and how Bitcoiners like put a lot of emphasis on being able to track the limited supply of Bitcoin, whereas Ethereans are not as have that much of a focus on it. It's also quite cool that within a few days, a lot of people came up with independent scripts that were able to get pretty much the same supply independently. So yeah, so that's it on monthly roundup. Next, Tempo will be introducing AMMs and vAMMs. Just a quick introduction, Tempo, before I give the floor to you. So Tempo is the co-founder and CEO of Perpetual Protocol, a decentralized perpetual contract protocol with a new type of automated market maker. He's also done a few different entrepreneurship ventures before, Decor, an accounting SaaS service that was backed by Binance Labs, and also QB, I hope I'm pronouncing that right, with 10 million downloads, a messaging app, and a couple other apps as well. And Perpetual Protocol is a decentralized perpetual contract trading protocol that allows up to 20 times leverage on long and short positions on basically any asset. And Tempo will be talking a bit more about them as well in his talk. So yeah, it's 8:15. Tempo, I give the floor to you.
Yeah, sure. Can I share my screen?
Yes.
Let me try.
I think I need to allow you quick. Yeah.
Okay. Okay, all right. Okay, yeah, so hi everyone. This is Yenwen. So some people call me Campo. That's kind of like my network or internet nickname. So I'm the co-founder of Perpetual Protocol, and we build kind of like the AMM for perpetual contract. Before I get into perpetual contracts, so I want to kind of like have an overview of all the AMMs and how it works, and then try to walk through like different kinds of constructions, and then go to like why we want to build a virtual AMM, vAMM. So before we start, I mean like hold on. So I think that okay, skip. So the first thing is that what is an AMM? So automatic market maker. It's actually, I think like in 2000, there are several, I mean, in traditional financial market, there are several automatic market maker, mostly used for prediction market. So people are using these market makers, like kind of like algorithm-based market maker to provide liquidity to prediction market buyers. But it doesn't really, I mean, have a lot of impact on the traditional financial market because I think they are private market. I mean, the financial market, traditional financial market is more like private sector. So lots of private company control like different parts of the financial system. So I think most of the market maker, they want to have their own proprietary technology trying to get, I mean, in advance, or I mean, I get kind of like in advance of others, or like try to take advantage of every different thing. So I think it's the local market maker is not very successful in traditional market. But in DeFi or in blockchain, actually, I think everyone knows that we are actually in a kind of like bull market right now. I mean, like DeFi is crazy, gas price is crazy. Personally, I think there are two things. I mean, one thing is that finally we apply a token model on the right place. I mean, we apply token model on the project like Compound that's already doing well. When you apply a token model on a project that already, I mean, they already have lots of token lock in the system. They already have people like borrowing on that system. You actually accelerate the everything, accelerate the borrow, accelerate the lending. I mean, they accelerate all the things on Compound, and then the same as Balancer. So it actually start here. So I think that applying the token model is the first thing. The second thing is that we finally has, I mean, like we finally has a way to do the local making market maker start from Uniswap. So so go back to local making market maker. So the first thing is that the first thing is an algorithm-based market maker that provides liquidity to the market. The second thing is that on chain, you always have a component that pool the liquidity, so you can become the liquidity provider to provide liquidity to the system, and then you benefit from by providing liquidity. So I think that's also a very important thing. The third thing is that it's a counterparty to all the traders, so traders can trade with local making market maker without permission. So I think that's also very important. Anytime, I mean, the local making market maker will give you a quote, and then you will fulfill that quote. So I think that's also very interesting. And the fourth thing is that it's very predictable. Most of the local making market maker, they have math, I mean, like a kind of mathematical equation to trigger that local making market maker. So it's actually, if you understand how it works, it kind of like predictive. So you can build, I mean, like you can build program on top of this. And then and at the same time, you feel, I mean, it's kind of like, it's like you understand how it works. But if you do the same thing on the order book market or on like BMax, you actually can, I mean, like, because the liquidity, I know there are lots of liquidity on BMax, but when things happen like in March, actually everyone is just like pull their order out of the book. So actually you don't know how much liquidity I mean I left on there. You have to do lots of calculations. So I think that's totally different. So that's why I think automating market maker has their own market. And also it's more composable because it's actually very easy to predict. Yeah. The last thing is that in most cases, it's very easy to create a new market on the automatic market maker, especially on Uniswap. Actually, that's actually the thing that trigger the whole growth. I mean, the growth, I mean, the DeFi growth, like start from like 2 or 3 months ago. Oh. Okay, so let me go faster. So here I just want to, I mean, tell the difference of I mean, like a protocol with automatic market maker and the protocol without an automatic market maker. I started working on crypto from like 2017. At the time, they are decentralized exchange. So they are Ether people trading like shitcoin on that. It's actually shut down now. They are IGEX, their new one. It's more like formal one, and people trade shitcoin on IGEX. Before you don't have to do KYC, but right now they have to do KYC if you want to trade on IGEX. It's actually very interesting. But at first, I mean, like on Ethereum or on DeFi, people copy the idea from centralized exchange or from traditional finance. So that's why we have IGEX first. But then people, I mean, like Bancor is ICO project very big at that time. And then Bancor launch is the first AMM project, but it's not really successful. And then UNISWAP launched in 2017, I think 2018 kind of like the time frame, but it's not very successful at that time. But after a while, in 2018, actually UNISWAP stopped picking up some momentum. And then the same, but IGEX actually stayed the same. And then the same thing happened on lending. Dalmar and Compound, they actually are the same. I mean, they started at around the same time. Dalmar is more like P2G model, like traditional finance, and Compound is a pool model. And actually, Dalmar has already pivoted to other things, but Compound actually stays, and then they are very big right now. So I think, and if we look at that things, so UMA is another protocol. Actually, UMA is doing pretty well right now, but they pivot. So they kind of pivot to an Oracle solution. But UMA is also doing the order book. Synthetic is kind of like pool model, but different kinds of pool. What I'm trying to say here is that the DeFi start from like traditional concept, traditional order book concept, but in the end, actually AMM is the one who actually scales and then who actually grows a lot later. Because I think because it's on chain, it's because like I said, it's more predictable, and then they are a large part of the traders are actually programmers, so they actually do lots of access the pool through like smart contracts, through like different kinds of programming interface. So I think that's actually why it happened. But I think it's very cool to see actually most of the protocols that actually stay strong right now are AMM based. So so like us, we are doing the futures kind of AMM. So we are kind of like here. Yeah, we can talk about that later. Okay, so I want to go through like several like different AMMs so that people can get like kind of like know how he evolved from the so let's start with Uniswap. So Uniswap launched in 2018. Before Uniswap, there is Bancor. It's a little bit different, but it kind of like popularized the idea of AMM. But Bancor don't really have a lot of success. Uniswap is the first one who made this concept really successful. I think they are like give like small, not a really big difference, but Uniswap make it. So we start from Uniswap. So the concept of Uniswap is very simple. It has constant part. They use the constant part of formula. So it has a formula here. So x multiplied by y equal to k. So so which means that if you have two pools, like x pool is die, y pool is if. So if I put something into the die pool, I put something in the x pool, and then I can take something from the y pool. I mean, the product is a constant. So it's actually like a graph underneath. So if we have more, die in the x pool, they are less if in the y pool. It's very simple. So people can exchange using this formula. I think this is very simple idea, but it's really powerful because it's so it's simple, it's easy to understand. It can price to infinity, means that you cannot buy out a single side of the pool. I mean, no matter how many tokens you put into X pool, there is always something in the Y pool. So I think that's also interesting way to do this. You can become the liquidity provider to the UNISWAP. You just put into 2 tokens in the same, in the same ratio. Like if there are like 10 dice, 1 ETH here, you can put in like 10 more dice and 1 more ETH here, and then you become the liquidity provider. This is also very powerful thing that people can, join the protocol and then become one of the provider, and then you take a piece of the fees. Okay, so that's Uniswap. And then we enter Curve. That I think Curve is very interesting, because personally I think Curve will be, it will be there for a long time. But anyway, Curve launched in 2019, last year. It's actually not very long. So it's a special case for Uniswap. So Uniswap is doing pretty well, but because of the constant power curve, if you have, when you trade like stablecoin to another stablecoin, you actually have, it's not really make sense because there are slippage. Larger. But you have this question that I trade DAI for USDC. Why do I have? Why should I pay for the slippage? So Curve actually tried to fix it, because you know beforehand that this is only for the stable asset basket. So for example, I have like 4 tokens: DAI, USDC, USDT, and True USD. Because beforehand I know the tokens are, in most cases, their value is the same. It's all 1 USD, 1 US dollar. So I can actually modify the curve to something like blue line. So the dot line is Uniswap. Actually, I kind of like design another line. So I just try to modify the equation. So it's actually very, if they are, there are similar amount of DAI tokens in the pool and USDC tokens in the pool, I actually will have a very, very small slippage on Curve. So it's make it very easy, make people are willing to exchange stable coins. So Curve is doing pretty well. I think their total lock value is over $1 billion. Yeah, so I think that they are doing pretty well, and they can have like more than 2 assets in the pool. So they have different set of pools that you can choose, and then you can also become a liquidity provider. You can share the fees. One thing, because the slippage is very slow, and also the design, they actually charge a very small fees. So if you want to, swap stablecoin, if you swap on Curve, it's actually, if you swap on Curve, actually the slippage is less than if you swap on Binance or other centralized exchange. But the gas fee is so high, so right now it's not a good thing. Yeah, so that's Curve. Okay, so just go through everything. So and then we enter Balancer. So Balancer is another one that kind of like a generalized Uniswap curve. So Balancer is actually, you can actually have like more than 2 assets, and then you can customize the weights. So what I mean by customize the weights is that like the example I have here. So I have DAI, I have ETH, right? So the weight of these 2 pools actually is the same. It's like 50%. So you have on Uniswap the weight, you have to set the weight. You cannot change the weight. It's always 50% to 50%. But on Balancer, you can change the weight. Why I want to do that? Actually, it's there are several cases you might want to do that. The first one is that if you launch a new token, actually the price fluctuates a lot. So you might want to put the tokens on the on a smaller weight. Why you want to do this is that then the token will fluctuate more, but the impermanent loss will be less. I don't want to touch on impermanent loss right now, but that's actually better if you do this for a new token. But they are, I mean, like different things. People are kind of like experimenting right now. So, but setting like different weights for the pool is one of the things. And then they have like they can have like multiple assets, like 3 assets. So below is actually a graph that 3 assets. So it's kind of like a 3-dimensional. I mean, 3-dimensional kind of like I don't know, chart something. But anyway, I mean, like it's a new thing. It's a new one, and it's very interesting that you can, by customizing the weights, actually you have different effect. So I think Balancer is very, personally I like Balancer a lot. I think this is really interesting, and then you can have more than 2 assets. Balancer also have this like very interesting one that actually we are using. So it called Balancer Liquidity Bootstrapping Pool. Because we talk about like the weight, you can say the weight. So they come out a new pool that you can actually change the weight dynamically when you want, or you can set a period of time, like a week, and then you want to change the DAI from 20 to 80%, and then the weight of ETH from 80% to 20%. It kind of like swap the weight. Why I want to do this, there are also different usage, but one of the usage is that if you want to do a token sale, it's actually is very interesting way to do a token sale. It's actually not doing a token sale. It's if you want to launch a token, it's a very interesting way. Why I'm saying that is because so here I have a chart. So it starts at like 1.6. So this is actually from like our, I mean our document. But I want to show, what I want to show is that you can actually change the weight. But when you change the weight, if there is no one buying or selling the asset, so if I put in like 10 DAI here and 100 ETH here, if I just do this, I don't change anything, and then I change the weight, actually you will create a effect that the token price stack, I just like goes down like this. Every time you change the weight, the price change, because price is actually the Balancer has a formula for that, but price is kind of like divided by the pool, the token value in the pool. So if you have, if you don't have any buy and sell orders, and then the price will actually go down within that period. And then you can, if you change the weight, actually you change this curve. So you can have different curve. This is interesting because if you want to do a token launch on Uniswap, the most problem we have is that there will be bots going on as the first, going in at the first block. Why they want to do that is because so like token projects, if they see the pool, in most cases, they are not going to take the token out. So everyone who took the token from that point will, their profits will always be positive. So that's why people actually will rush in at the first block. There are bots that actually watching all the Uniswap transactions, and then for all the token it recognized, you just put ETH in that token, in that pool. So actually there are lots of bots going on in Uniswap right now. But I think that's actually very interesting for Uniswap. but it actually is very bad for the project owner and also for the people who want to get the token on Uniswap, because they are always be front run. So in this case, actually, you are not easily be front run, because when the bot enter the first block, he has, he must know that the price actually is going down. If there is no one keep buying the tokens after, actually he will lose. It will lose. So for any rational bot, it should not come in at the first block, because the price is going down. So it should go in the pool at a certain point of time that they think that there will be buyers after to compensate the loss, right? And then it becomes the market price, and then that's how we discover the price. So it's more like price discovery. So I think this is very interesting. That's the things that you can do with Balancer. Yeah. So the last one is Bancor. Bancor 2 is very interesting. It's another kind of AMM with a price feed. So they use Chainlink as the oracle. It's actually a very interesting way. So we have, so on Uniswap, there are, so on Uniswap, suppose that, so we have a pool of ETH and DAI. So ETH is like 450 right now, and DAI, so 450 DAI is equal to 1 ETH. Every time ETH price change, like ETH goes up a little bit, the arbitrager come in, and then they trade, right? So they take a little bit of profit, so they move the price. So Binance price goes up, arbitrager comes in and then buys up a little bit on Uniswap. Arbitrager is kind of like it's not like the mechanism, but the arbitrager helps Uniswap to maintain the same price as other exchange. So that's how arbitrager works. But at the same time, arbitrager has lots of profit, because they just move the tokens, right? So they can buy tokens at the lower price and then sell it at a higher price. Everybody can compete in that game, but it's how they earn the profit. But the profit actually comes from liquidity provider or the trader, right? So it's a zero-sum game. So trader, arbitrager, liquidity provider. If arbitrager take out some profit, then the trader lost or liquidity provider lost. I think that's the case. So Bancor, they actually figure out a way to kind of like prevent this. How they do this is that they use the price feed. So just like what we said in Bancor, you actually can change the weight of the two pool. So if the price goes up, and then I change the weight of the pool, and then because every time I change the weight, the price sweep, right? So if I can sweep the price, and then the arbitrager don't have that profit, he might still have some profit, but I shift their profit to other stakeholders like liquidity provider, or actually switch to the traders. So trader has less slippage. So actually it's kind of like very interesting. So it kind of like dynamically change the weight of the pool. So I think that that's really interesting. I think the drawback is that using the price feed is very, how do you get the right price feed is very hard. It's the price mine. If you want to have a stable price feed, then you have to exclude a lot of tokens. And for those like long-tail token or new project token, you cannot be listed on Bancor too. So I think that's a drawback. But otherwise, I think this is really interesting. Okay. So yeah, I talk about like different AMMs. Like recently that published, they are still more to come. I think this area is growing very fast. But I do want to mention one thing is that I mean, I used to work in like financial, company, tools company before. So if you want to be successful in traditional finance, I mean, it's it's a manufactured thing, but I mean, like relationship, the sales skill, understanding of the financial products, or how to build a new financial instrument. They are all factors. They are all important. Different roles have different needs. But in DeFi world, actually, I think the math and financial engineering is the pyramid. If you can figure out a way to, so we talk about like Uniswap curve balancer, they just kind of like modify the constant product curve to a new form that fit a better scenario. If you can figure out something like this, actually you have, you can build a protocol by this, just by figuring out a use case that you can have a spatial curve to fulfill that use case. Personally, I think this is really powerful. I'm not like math background, but I think this is actually changed a lot of different things. From here, it's more like software thing or like math or financial engineering. So I think if you are interested in here, definitely give it a try. I think that's very interesting. Okay, so that's one dimension. So I think I spent a lot of time talking about the new AMMs. Most of the AMM, they try to change that curve, either by like modify its shape, or like introduce like multiple dimensions, or have a price feed to dynamically change the curve. That's different ways to do this. And then for us, actually we are more using more different ways to do. To change the virtual the AMM. So Perpetual Protocol, so we are doing the decentralized perpetual contract on Ethereum with Virtual AMM. So you can think of this as more like a Big Macs with Uniswap. So what we want to do is that we want to have leverage on AMM. So it's a special case. It only for perpetual. Why you want to trade perpetual is that because some people want to trade perpetual because your fee is low, but the most cases you want to have leverage, and the second thing you want to short, right? So that's why people trade perpetual on FTX, on Binance, on BMX. But for Uniswap or for like AMM we have right now, before Perpetual Protocol, we cannot have leverage. Why? Because we put the token in the pool. So if we want to do 10x, how can we put 10 more tokens in the pool, right? So that's a simple question. So what we try to solve is this. So you can see us is more like we can kind of enlarge the pool to a certain degree. Not always can X, but to a certain degree. So they are more, the actual token is here, but we enlarge the pool. So how we do this is that it's actually very simple. So this is a kind of like a flow chart. So we talk about like AMM. So like this AMM is more like Uniswap. So if you put something in X, you can take, some tokens from Y. So like Uniswap. But why we call it virtual is that we don't put in real tokens. We put in a number. Oh, so how it works is like this. So suppose there is a trader who wants to get 2x average with 100 USDC, which means she wants to have like 200 USDC kind of like buying power. So what we do is that we actually put 100 USDC in a vault, and then we just put 200 in the Y pool. Okay, so it's actually very simple, and but why can we do this is that because this is a perpetual contract. So if everyone is trading with our our system, then we will always have enough collateral in the vault. Why that is because we use a constant power curve, and then there is a math property that is called path independence. So like trigger Alice pull in like 200 in the Y, and then suppose that they are like 10,000 in the Y, so it's like 10,200 right now, and then trigger like Bob putting 200 here, and then trigger Alice actually, if she removed the she closed the position, we took 200 out, and then Bob took 200 out. Actually, if everyone trading against the virtual AMM, actually, we always have enough collateral in the pool to fulfill that. So I think that's the difference from like what others doing and then what we can do this. So that's it's only, but there's still other questions like how can we make sure our price is the same as like price on Binance or other place. So we have funding rate for that. So that's kind of like how it works for the PERP. Yeah. Yeah, I think that's actually all my slides. So yeah, I don't know if anyone has like questions. I can answer anything. Yeah.
Okay, cool. Thanks, Tempo. I'm going to allow people to unmute themselves. Please don't abuse that power. And feel free to ask your questions. If not, I can ask mine first. So I saw somewhere that Perpetual says that you have a mechanism to stop front running. Can you elaborate on that a little bit more, or is that what you were mentioning earlier with the balancer graph?
Mm-hmm. Yeah, this is how balancer can stop front running. So it actually, I mean, it's not like stop front running. It actually create it kind of like create a game for the bot. So I mean, like the bot has to think about like which is the right time for the bot to enter, and then the bot become the token buyer. It's actually kind of more like a game theory. You have to guess like when if others are coming in at the price like 50 cents here, and then you should join because actually the price will goes up here, and then actually you have better winning chance, I think. So it's more like game theory. Yeah.
But does that apply only at the beginning of a sale, or is it an ongoing mechanism? You know, even 1 year later, it can help prevent front running.
No, it's only at the beginning. Yeah. So there are different kinds of front runner. I mean, there are like general front runner. It front runs everything, right? So that kind of front runner, I think it has to be solved on Ethereum itself. But for this, I mean, like if you want to put a token on Uniswap, I mean, you will get front run. I mean, like 100%, and then the front runner earns. I mean, like BZX, they did this. The front runners earns like 500K, like within like an hour. So that's actually a large number, or even more. I don't remember, but it's around there. Yeah. So I think that's if we can prevent that, I think that will be, I mean, much better for compared to other things. We also, I mean, like trying out other things like Mesa. So Mesa have this auction protocol that you can do the auction, and then everyone will get the same price. But personally, I think Mesa still got front run. So it's, I mean, like it's really hard to prevent that. So I think Balancer has a chance. No one actually wants this before we are the first one. So I don't really know. It's just like in theory.
Okay, cool. So YZ Money actually asked earlier. So like two questions essentially. First one is there a difference for liquidity mining on a perpetual contract versus other platforms? And secondly, how much volumes are you expecting your platform to handle?
Okay, those are good questions. So I think the first one is so our liquidity mining is very different from the liquidity mining people are doing right now. So people are doing so the liquidity mining people are doing right now mostly for the lending protocol or the exchange. So either being the liquidity provider or be the lending provider. So you put the token in the pool and then you earn new tokens. So that's how it works. But for us, because we don't really have liquidity provider in our system, so what we do is that if you trade on the platform, we reward you on the we actually rebate you the transaction fees. So it's more like transaction mining. So the fees actually more than the fee you pay, but we lock the token up to a year. So you kind of like we're actually thinking changing it to like linear unlock. So you have to lock that token, but you actually earn more token when you trade. But it's locked, so you still have to pay for the fees at the beginning. But I think that that's the way we want, because for us the most important, I mean, stakeholder is trader. So we need more traders. We want people trade on here. So I think that's something we want to provide. So it's very different. So it's actually you trade on the platform. It's not like you lock a token here. Yeah. Okay. And the second question is how much volume we can handle. I think that's more a question of how much volume Ethereum can handle, right? I think that's for us, I think we don't really have that problem. I think it's all on Ethereum itself. I mean, Ethereum is like it is. I mean, it has much more. I mean, like volumes it can handle now. So it's actually for us, it's actually a very big problem right now because we actually are ready to launch on mainnet, but the gas is so high. So I doubt people are going to trade here. So I think that's actually the main issue we have. Otherwise, I don't think for this, I mean, we don't have a cap on the open interest. That's a good thing. So we don't really have a boundary on the system. I think I mean, Ethereum has to fix something, or we have to move to like layer 2. Yeah.
I was just going to mention whether you've had any discussions or thoughts about changing to a layer 2 chain.
Yeah, actually, we are working on that. We have we kind of have this chart that we compare everything. I mean, so I mean the problem of layer 2 is that almost everything you see here is not on mainnet. If that's on mainnet, that's another chain. So I mean, there are only like a few we can use. So I think that's a big problem. Yeah.
Yeah. Okay. There's some other questions here. So just now you mentioned on Balancer there can be a change of weights. Is that done automatically, or can any LP liquidity provider change it, or how does that work?
Okay, gotcha. That's a good question. So Balancer actually they have different concept of pools. So they have share pools, so people can, most of the pools are share pools. So for share pools, is that once someone create this, they cannot modify this. So they cannot modify anything like the weights, like add a new asset. They cannot do anything on the pool. It's kind of like a read-only pool. So that's a share pool. They also have a private pool. So for private pool, actually you can update everything. You can update fees, you can add new asset, you can do a lot of things, but people cannot provide liquidity. on the private pool. So it kind of like protect the liquidity provider. So people will not like accidentally join that pool and then got lost. So the LBP is a new one. So they actually create a new pool that actually they can, it's kind of like a private pool, but you can add, I mean, like you can have different people to become the liquidity provider. But the rule is preset. So you can set, like, if you want to have the weight change, and then you have to specify the start time, the end time, and then how you will change, something like that. Once it start, I mean, you can actually update that, but it's kind of like a preset thing. So you have to preset that. Once you set, the weight will not change automatically. You have to have someone become the keeper, kind of like update the weight. I mean, if you want, or for every order, you should maybe update the weight first because you might get a better deal. So that's how it works. Yeah.
Okay, so if I understand it right, someone can still change the weight afterwards. Is that person like voted on or?
No, it's actually someone can update the weight, but the weight actually is predefined. So like, so for example, we have a pool with like 80, 20, 80 ETH, 20 DAI. And then I want to have this like in a week, change from 80 to 20, and then DAI change from 20 to 80. And then I can set like, so 80 to 20 in 7 days. So once you set, you actually start, I mean, you start the counting, but the weight actually won't change unless you call a certain function called update. So you have to update weight. So a keeper must like constantly update weight. So that's actually how it works. Yeah. So the keeper who update the weights cannot change that parameter. It just like help to kind of like rebalance the weight.
Okay. And I think we're almost out of time, but I'll squeeze in like one or two last questions.
Sure.
And we try and keep it short. I'll try and keep it short. So, so when you mentioned the LBP sale just now, it sounds a bit like the reverse Dutch auction, I believe is what it's called, that Gnosis did, where the price like naturally drops over time. But in their case, it actually ended up with people like FOMOing and bought a lot at a much higher price than what they expected. So is that something that might happen here as well?
I think it's I think this curve looks like a reserve Dutch auction, but I think mechanical wise is very different because you cannot buy out all the tokens, and then the reserve the Dutch auction actually when the price goes down, I mean when the price moves to like 50 cents, it stays here. But for balanced liquidity bootstrapping pool, it's different. If there is a big order here, actually the price will go up. I mean, it's still a balanced pool, or it's still like a Uniswap pool, but with a constant selling pressure. So it's more like people. I mean, like there are people like selling like tokens at any given time. So the price actually there is a selling pressure on the tokens. So I think that will be, if you think about this, and then that will be more, I mean, more like the balance LBP. It's actually very different from the Dutch auction.
Okay, cool. Thanks. Okay, so I think we want to give, there was some questions from community members about how to participate in Perpetual Protocol token sale or liquidity mining. So Tempo, maybe you can spend like just a couple minutes to explain a bit more how people can participate.
Sure. So I think there are two ways to, if you are interested in getting our token. So the first thing is that the token can be used for governance and also for staking. why you want to stake is that you can actually have staking rewards. So we have these like rewards to, so it's like inflation. So we will reward the staker. So that's the first thing. The second thing is that you can get a piece of the transaction fees. So the trader pays fees and then staker can earn the fees. It's more like synthetics, how synthetics works. So that's the advantage of being a staker. Yeah. And how do you get the token? There are two ways. The first thing is that you can buy from the balancer pool. So you can buy, actually you can buy when the balancer LBP pool launch. So we schedule the launch next Monday. But please don't buy it. If you listen to this code, don't buy it at the first few hours because you will get wrecked. I mean, like, if you are going in here, I don't really think you understand what I'm talking. You should, I mean, stay like maybe like check this out like second day. That's something I would suggest. But this is, I think going through this personally, I think the price will be lower because the design. But it's just in theory. It's just in theory. I mean, like, it's always a risk for any tokens. I mean, like, it's something we build. We need staker for certain parts of the system. That's because staker provides some kinds of security to the system. But anyway, if you want to get the token, so one thing, go to balancer. You can always buy from like balancer like in a week, in a month, in a year. So it should be there. So you can pick up if you want. So the second thing is that you can do the liquidity mining. Liquidity mining, like I said, when the platform launch, you can just trade. You trade here. I mean, we will rebate our own token to you, and then that I think that actually we have more token that we are going to give out to the trader at the beginning. So I think that will be a good opportunity to get more token. Yeah. So I think that's the two ways to get tokens.
So just to clarify, so liquidity mining, it's both when you provide liquidity and trade, or just one of the two?
Just trade. Our system, we don't need liquidity provider, so no one provide liquidity. Yeah. Okay.
So if you provide liquidity on balancer, for example, there's no reward for doing that.
There will. I mean, like, I think the reward will be like short period. We just probably want to build up some liquidity on that on balancer. That's it. Yeah, it won't be. Will not be like a long-term thing.
Makes sense. Johnson's asking, we probably can get BAL token for doing that. Do you know if users would get that?
Get
a balancer token, because what I understand is you get the BAL token for providing liquidity on some pools.
Yes. So I think he's asking about the balancer liquidity bootstrapping pool. I mean, like the LBP. So for this, actually only the PERP. I mean, only the protocol itself. We are the liquidity provider because no one has PERP token, right? So I think we are the LP. I actually never think about this. I think we will get some like BAL tokens. But in the future, I mean, like we will. So after this, I mean, after three-gate period, we will actually create another share pool, and then we put the token on the share pool. Why you want to do that is because the share pool, I mean, is more like strict, so people have less concern about the kind of like, because on a private pool you will have a root user that can control everything. So on share pool is better. So we'll have a share pool, and at that time, if you provide liquidity to that pool, I think you will get the BAL token.
Okay, and another thing to clarify on the buying from the LBP, when you say you wait for a few hours, that's assuming a rational market, right? Because we know the crypto market's not necessarily rational, and someone might buy in early expecting the price to go up by a lot higher. So that could happen as well.
Yes, that could happen. That could happen. But yeah, so I would say this is more like game theory. I really don't have a good answer for this. But I think, but this is a curve. I mean, like this. I mean, so you can see that the price goes down at the beginning very fast. So I don't really have any. Even if some people buy it here, I don't think you should you know, go in the pool here. I mean, because the price scale, I mean the weight scale change. Even if you got the token here, it actually can go down from there. So I just don't feel that it's a rational thing to do that.
Okay, yeah, it'll be interesting to see how it actually turns out. Yeah, just for learning's sake. Yeah, so thank you. Unless anyone has any final questions, we're a bit over time on Tempo's section. But yeah, if not, thanks a lot, Tempo, for sharing with us.
No problem.
We're going to be discussing sort of some liquidity mining and yield farming, just open discussion. So you're free to join for that. But if you're not able to, that's fine as well. I'm going to share a Google Doc here. So for those of you who've done this before, you'll be very familiar. I'm going to share the link into the Zoom chat, and then people can edit on there directly, or please feel free to chip in with your voice as well. But yeah, so just to kick things off, so there's liquidity mining. First of all, just to give a very basic agenda to it, we have about 20 minutes. So just to go over what it is and some pros and cons of doing that. So I'll just give my understanding of liquidity mining, and people can correct me for anything that's missing. And if anyone wants to chip in as well, again, I think you can unmute yourself already. And sorry, now you should be able to unmute yourself. And yeah, you can add in your thoughts as well. So my understanding of liquidity mining is the way I explain it to my my non-crypto friend is if Grab allowed people to get some Grab shares whenever they are either a passenger or a driver, and immediately after the ride is over, they can sort of sign into their stock market, Bursa Malaysia account, and immediately sell that shares off to a secondary market out there. And they can do that also for, let's say, if Maybank were giving their bank shares, and you can even say if Maybank were to give shares, you could lend out those shares to someone else to get a reward from, say, Grab. So you can cycle through those rewards as well. Oh yeah, Johnson has some notes on yield farming, so just open it. Johnson, do you want to add to that introduction? Oh, wow, that's a... Okay, that's... let me unmute you quick.
Hello?
Okay, Johnson, you're unmuted. Yeah. It's a very lengthy note, I must say.
All right. I mean, I've been doing this for like a month plus. I think it's quite interesting in this space about all these farming things. But just want to give like a quick caution about all these things. It's really, really risky. Always do your own research. And this article are just for educational purpose only. And again, it's really, really, really risky. If you don't understand what you're doing, try not to go ahead. Yeah, I think for yield farming, basically it's just a gamification layer on top of how you distribute your token. Yeah, I think I think in this article, I written out a few things that you should look out when you want to farm this token and whatsoever. Yeah, I think this basically, how can you scroll down a bit? Hello?
Yep.
So I have a few definitions and all those stuff towards like a few things that you can take a look. I think the best article I think so far I read about reading to really understand yield farming is from the Daily Gray, written by the founder of Token Sets, Anthony. So he shared about type of yield farming and what kind of things that people have been designing and building and all those stuff. Yeah. So he classified yield farming into 3 categories, which is in my article. I also share like 3 different kind of strategies. I kind of categorizing them into all these different strategies, and some of them are other strategy. And towards the end, there's like a way that, because all this yield farming is very risky, and if you only have small capital, you shouldn't try all these things because the gas fee gonna kill you. Yeah, I think that basically layouts. If you got time, just take a read into all these things. I think this is mainly for my note size. I really didn't prepare much on my end for this, but I think this would be a very good summarize. I've been reading like a lot of smart contracts or new contracts. It's really crazy. The every day there are more than 5, 6 new projects launching, and you see them just copy each other. Yeah.
So I have a question, a bit maybe slightly off topic. My understanding is there's essentially generally 3 types of sort of yield farms. There's the YFI type, where there's like an investment fund, and then there's the YAM type, which is like a rebasement, and there's like the sushi swap type, where it's a AMM and you like provide liquidity. Are there other types of yield farming out there?
Those are the most popular one that get a lot of attention. There are smaller one like incentivized mining from Amperforth Gazer. UMA also have like incentivized farming for, I forget what's the pool already. I think it's in the article. I think mainly just we are talking down the hype is classified as what we call a flash farm. It's not really sustainable. It's just meant for you to normally farm for maybe a few days, and then everything just kind of die. It's not really sustainable. So these are more towards like opportunities. Like if you willing to risk all your capital just to get a new token that there's no guarantee there's a value of it, yeah, you can go ahead and do it. So that's what happened in the flash farm kind of concepts. So the second part of the there are a lot of flash farm these days. So the second one is more like incentivized. So some of the LP, because being a liquidity provider on Uniswap balancer is not really profitable, and you expose yourself to something called impermanent risk, which a lot of people don't understand. And I suggest you go and research about it. If you want to do yield farming, really study thoroughly about it. I personally experienced it, and I learned it the hard way. Okay, I paid the tuition fee. So the second method called incentivized liquidity pool is that some of the project, when they just first started, they want to incentivize people to provide liquidity, because if they don't have this incentivized program, nobody want to expose to the impermanent risk and put money into being an LP provider. So these are the second way about sustainable incentives. And the third way is more organic, which is what we normally call sustainable farm. This is more towards, like, you can take a look on pools.fi. They have a very curated list about what kind of pools that you can provide LP. Normally, people prefer like 2 sites of similar kind of token, like SUSD or DAI. Then you reduce your risk from impermanent risk, because both of the token are quite stable. they won't have a very drastic move in the prices. Yeah, I think also added a small part about Hive and Steam, because that was like a long time ago. There's a mechanism on chain, on that blockchain, that you can literally lend your token to other people, but the token is locked on your own self, and then you just delegate to that person, and then that person can use that token to vote on a post and incentivize others posts. So this was like a mechanism back in like 3-4 years ago, where that was my first exposure to something like on-chain delegating and then get money. And it's quite interesting because that one, during that point of time, you can get like what 40% APY for, maybe you can lease it for maybe a few weeks, and it's totally, everything is done on chain. So you don't need to risk that your token are going to go wrong or someone steal your token. And you can just remove the token at any point of time, and the payment is done on a daily basis. Yeah. And the last part will be other kind of farming, maybe based on leveraging, or maybe like the comp token farming. A lot of people like to during the start of the yield farming, there's a comp token farming strategies where you will leverage your borrowing with your comp token, and you just keep on borrow a lot of comp token. Yeah. And then these are all these things about farming, which is a lot of work to study, a lot of risk. If you are a lazy farmer, and you're a small farmer, just use the last part of this. Too lazy to farm, small volume, want to save gas costs, use automated market farmer. Sushi Farm, I was studying their code. It's very interesting. It's done by an engineer from UMA. YVAL from Yenwen Finance, and then there's others like Token Sets and API Finance, which is coming up soon. Yeah, I think that's the TLDR about yield farming. I think it's a very broad concepts that covers a lot of different platforms. So that's why it's very hard to summarize in like just 10 minutes. So this is just a very quick view about how it works. Yeah.
Okay, I think we're all gonna have to like read over the next few days or so, just to go through the whole list. JW asked, why ETH Vault, is it good or not?
I saw the yield is very high. I think it's like 90% APY. I'm not sure how it works. I haven't really have time to take a look into it, because they just deployed literally this, I think yesterday or this morning.
Yeah, I have a tweet I saw about how it works. I'm just going to share in the chat. I haven't properly gone through it myself, but it has like a nice infographic. So if you go over it, you can feel free to share with us as well later. Okay, so we're about 10 minutes left. Yeah, I'm going to make sure we at least cover some of the other points. And to me, it's very interesting also is to discuss like the pros and cons of liquidity mining. So I guess we can first start with the pros, and Tempo, I guess you should be able to share the pros as well, but maybe from an outsider who's not running a project that's doing it, one way I can definitely describe is I've used to work for a project that did an ICO, and one of the big problems that I think many people didn't anticipate was literally the price to list on an exchange, and that could take up like a huge chunk of any fundraise. And with something like liquidity mining, you create hype around your project, and you can see like even with Comp, when they first did it, they were listed by a lot of these big exchanges, where if they didn't have liquidity mining, they probably would have found it a lot harder to list or a lot more expensive. So that's one pro definitely that I can see for the project.
Actually, I agree. I think that it's just one way. I mean, like liquidity mining is definitely one way. The other way, of course, is that your product is very, widely welcomed, and then people are using your product. I think that's also one way. I think that's the thing we want. I think that so we are not doing the liquidity. Okay, I think the problem of liquidity mining is that there are lots of projects. I mean, all you think about of that project is liquidity mining. I think if that's the case, then it's probably not a good sign. I mean, like it will fail. I mean, like it will fail probably sometime. I mean, like as a user, so you are a user, so you go to the project. All you think about is like how much sushi I can get. Then I think it's really, I mean, the chance of that project become successful is really low. But for Yearn, actually I like Yearn. I mean, like we actually not really doing a liquidity mining. It's just kind of like a token distribution to the Curve pool at that time, 2 weeks, and then that's it. But Yearn, people remember Yearn because it provides all different votes, different strategy, and then it's a robo advisor. So I think that if I remember Yearn as a robo advisor, and then I think it's actually better. So that's how I think. But at the same time, I also put money in sushi shop because let me tell you this. So because I read a tweet, I mean like just a person account, actually our investors account, Twitter account, and then the description said, do you want to be making money or do you want to be right? So I kind of like understand this. He is a very famous trader, so I kind of understand that not everything has to be right. I mean, like something like that.
Yeah, and I think you touched on one good point also for the like potential sort of investor. And I don't necessarily agree with this 100%, but there is a sense of having a fair launch where you know, if you do completely liquidity mining from the start, no VC has a advantage over you. No person, technically speaking, who has like better connections or you know geographically is in a better place, get to kind of like front run you on a sale. So that's one pro as well. So even if you're a nobody, there is an element of gas prices where you know if you're not a person who's rich enough or crazy enough to spend high gas prices, then you don't get to necessarily benefit from the liquidity mining.
Actually, I don't really agree on this. Personally, I don't agree. So actually, I'm kind of like 100% don't disagree. Why is that? Because all these liquidity mining are whales. Oh, I mean, like, you think they are not VC? No, they are VCs, they are miners. Lots of like Chinese miners, they just put all they can into, because I mean the fees, they don't care about the fees. Why? Because actually they are miners. Why do they just package their own transaction, right? So they don't care about this, and then they just put everything there. I mean, like, those are people. How do you tell a VC and the whale? To me, that's the same. I mean, that's rich people. I mean, the whole like liquidity mining is rich people's game. Why? Because the richer get the most tokens, right? I personally don't think this is a fair game. I mean, a lot of people talking about fair launch. It's not fair at all. I mean, like if we have a quiz, like everybody taking the quiz, and then I think that's fair. But I mean, like in some way. But anyway, I don't really think this is fair.
Yeah,
Their job is fair, probably.
I guess there is one element of like if you don't have a connection, like you know, if you're a Silicon Valley or Shanghai kind of investor, then if it's a kind of a VC race or even an ICO with a pre sale, then you might be able to get in because you know people. Whereas if it's liquidity mining, let's say both sides are rich, but if you don't know anyone, you can still are able to come in. So it's fairer for the rich people, not necessarily fairer for the not rich people. Maybe.
Yeah. Okay, I agree with you on this. Yeah.
Yeah. Okay. Then okay, we have about only 3 minutes left. we can go over the cons. So if anybody has any sort of thing you want to share on the cons of liquidity mining, feel free to give in the sort of 3 minutes that we have. So I can give one, and it's the kind of very obvious one. It's causing all these gas prices to go up. And so I read recently there was someone wrote that there are front running and back running bots that are causing pretty much like 10% of the whole, like taking up 10% of the whole of gas or the whole chain. And it's not necessarily just liquidity mining, but liquidity mining gives them a lot more incentive to spam the network. And yeah, that's not good for everybody else. Tempo, as someone who, sorry?
Sorry, I think the cons mainly are just the expose of risk, because a lot of them are unaudited code. So you have to put your stake in all, like maybe a few thousand, a few million on board, and then do you trust the code? Have you read the code? Yeah. And then maybe you just spend like 5 minutes to do a diff check. Is it good enough? Have you really read through? Have you really checked where the owner key, which owner key is it pointing to? And there are a lot of contracts, maybe there are like 5, 6 contracts that point to each other, and you're gonna scratch your head. And then like the rebase from Yen, there's a vulnerability that causes it to what do you call it? Inflationary, create like a lot of Yen. Yeah, I think there's a lot of things that people don't care right now, but soon when there are a lot more cases of scams, I think people are aware about importance about a code being audited. Right now, I think everyone just want to put in all your stake because they are FOMOing like, oh shit, if I don't go in, I'll be late. I can't get the token. Yeah. I
actually think that if, and this is kind of a very bad thought, but if only that YAMM bug resulted in all the stake being locked away, then maybe people would be a lot more scared to essentially gamble. But yeah, that would have been like 600 million of people's money. And yeah, that's not very nice thing to happen.
Yeah, and then what SushiSwap did also quite interesting. They launch it and then they say, oh, we're gonna take a part of the funds and then we pay for an audit. So it's like launch first, audit later.
Well, I mean, you can also argue that as a pro, because if you were like assuming you were a project that didn't have much funds, you could bootstrap yourself to afford an audit, where before that you might not have the funds to pay for it. But I think it can be argued both ways. I was going to ask Tempo, as someone who is doing liquidity mining, do you have any cons that you personally would like to share?
No, I think we touch base everything. I mean, yeah, be careful, don't get wrecked. I think that's it. Don't go through those like, so they are like a kimchi today or like something, I forget. He just, I mean, like,
yeah, I think
lots of scams.
Also in the article, I also shared like a few red cases. So do take note when you read all these red cases, because you always see the good side of things like all those liquidity APY, 7 figures APY.
Yeah.
It's like you never seen before, but it's not sustainable. Maybe it only lasts for 2 hours and then it's gone. It's even faster pace than even like all these things. It's getting faster and faster, because previously even like maybe like 2-3 days. Wi-Fi maybe took like 2 weeks, and now we're talking about maybe 2 hours. Where I was driving back home, and then there's like new farm coming out. I was like, oh, okay, I can't miss out.
I was just told by a professional yield farmer earlier today that he hasn't slept more than 2 hours for the last 2 days. So
yes,
yeah,
sir, you can't sleep.
So it's a very risk. And I think I assume everybody here knows this, but a good thing to also share is that never send tokens to a token address. I think there was recently, I think the IO sent 200,000 to one
USDT.
of the, yeah, to one
contract.
Yes. So yeah, please don't do that because no one can save you. But yeah, okay. Thanks. Thanks, guys, for the discussion. We're a bit over the time. I do want to make sure people can go off on time so that next time you might want to join us again. So yeah, thanks again, Tempo, for sharing your time. This is recorded, so if you feel like you missed a certain part or you didn't understand Tempo, you can watch it later. And then, Tempo, do you mind sharing a link to your Telegram group so that if anyone wants to ask any further questions, they can ask? Yeah, you can put it in the chat window.
Sure.
And yeah, so ETL, we do have a Telegram group. So all the links that was mentioned earlier in the monthly roundup and any Perpetual Protocol related links, I will share in the Telegram group as well. So yeah, okay, Tempo shared the link there. So please join that group if you have more questions to ask. And yeah, so thanks everybody. Again, tomorrow 5:30 p.m. there is a Crypto Malaysia Meetup at Asia Blockchain Center. So if you're free, feel free to join. It's hosted by Aaron Ting, who is like Vice President, I think, of Access Malaysia. And there's a lot of other people who'll be there as well in the local space. So yeah, if nothing else, thanks everybody for joining. Remember 7th September, I think, is the when LBP starts, but wait a few hours if you don't want to pay for a high price. Or if you don't trust in the rationality of the market, then go in a bit earlier.
Yeah.
All right.
Thank you for having me. Yeah.
Okay. Yeah. Thanks. Thanks a lot, Tempo. See you guys. Bye.
See you.